Thank you very much indeed. And we've just heard here earlier a fascinating debate about the merits and demerits of working within an ESG framework. And once again, I'd like to commend both Frank and Hester for actually standing up on stage and discussing this in public, because we need more of that open debate and airing. I'd like to start, before we go into the main topic in this panel, do any of you have any reactions or comments about how you see the NGFS and the regulatory framework developing today? It's called How to Make a Bunch of Private Sector Players Deeply Nervous to be asked in public to comment on regulators. But I'm just curious about whether you think, anything you heard just now surprised you.
So I wouldn't say it surprised me, but I will say that, what we're seeing is that all the rules are being written in Europe. And I think not having the American perspective or at the seat of the table, even if it's a contrarian view, we think will eventually be hurting companies, the American companies. Because if you think about the recent regulation that came out on climate and what kind of strategies to create for benchmark reasons to align with the Paris Accord, they define what kind of companies to exclude from strategies. And I think that when you see in Europe, every government is supporting and defending its main businesses and companies like the French with nuclear power, right? And that's not happening here in the US.
Yelton, I see you're nodding over there, Steele.
Well, my initial reaction to the remark is that at the federal level here in the United States, there may not be that push for regulatory frameworks, but we're going to see it at the state and the local level. We've seen that in the response to the U.S. stepping away from the Paris Accords and the willingness for state governments and local governments to step up and still commit to those targets. We'll see that emerging here in the United States, I believe.
I mean, I must say, I think it's very striking that the New York state regulator signed up to the Network of Greening Financial System last month. Dallas Fed has come out recently and said some pretty striking things, even in Dallas. And I would put quite a lot of money on the table that the Fed itself will become an observer quite soon. But anything that you guys wish to add to this, and then we'll move on to the impact investing world.
I mean, I would say, no surprise, but it certainly helps Europe to position itself this way, because to build a regulatory mode to support its own industries is one of the things that can come out of this. And secondly, European companies are also looking to Asia, where concern about environmental factors and other things are on the rise. And I think the U.S. is missing an opportunity here to be something of a global leader, setting global standards, which may now be set between Europe and Asia.
Right.
I'll just add, so NGFS includes pretty much a lot of global actors. It's not just European driven. And so I think that's an important point in terms of some level of harmonization around this is actually quite important. But I don't think it's necessarily an either or. It's not, you have to have a very prescriptive approach to, how you define things or set, regulation or prudential regulation. I think you do need some level of framework, but then you also need to enable the markets to be able to do this. And I know there's been a lot of debate as an example around things like climate transition activity and how do you actually help facilitate that, given that in some ways the bulk of the economic activity, it's not just the greenest or the brownest, it's everything in between that you really have to incentivize and facilitate the movement of to become more sustainable. And I think in that regard, taking a more expansive approach, but with the right framework in place, I think is actually quite important to strike the right balance.
Right. I mean, Nordea is in the center, ground zero of climate change activism in terms of using the financial system in some ways. How does it look to you?
Well, I think I would add to this that for ESG investors, also state-level registration legislation in the U.S. and also in other markets is equally important. And if you look at, for instance, when we look at S from a kind of a fundamental investment point of view, the California Consumer Act has a lot to do with how corporates interact with society in terms of data privacy, for instance. And those types of legislations, I think looking at them is nothing new for ESG investors, and it's something that we factor in our investment decisions every day.
Right. Well, moving from the, if you like, the regulatory constraints and the way that governments are moving, what we just heard earlier is obviously a big shift bottom up from consumers, from investors, in terms of attitudinal shift. And of course, one of the things the financial industry has been telling everyone recently is that although it used to be a case of investing for good or making money, increasingly the two things can be combined. Mark, is that just sales pitch? I mean, do you actually believe that we're moving into a world where impact investing, investing in line with ESG goals, actually doesn't involve a sacrifice?
We think that it does not involve a sacrifice. There are thousands of academic studies that show that these are kind of equal in terms of their investment performance. But we actually think that there are several reasons now, while looking forward, proper sustainable investments and impact investments can outperform. And some of those include just the fact that more and more people are demanding these assets, and that means there's a tailwind from the demand side. And then the second that we've seen since the financial crisis, that companies that violate social norms are punished very strictly, either by the regulators or by governments or by consumers who vote with their own pocketbook. And so looking at sustainability carefully can help companies cut off some of the downside risk.
Right. What about the issue about scalability, though? Because, you've seen lots of small, tiny impact investment opportunities develop. One of the things always, we point out ad nauseam on Moral Money, our ESG platform, is that although the overall ESG universe is supposed to be, was it $33 trillion now, impact investing is tiny. I mean, absolutely tiny. Is it scalable? Mark or Mario?
Well, I guess the global impact investing network estimates that in 2019, the impact investing kind of pool is about $500 billion US, right? So out of that, around 28 to 33 trillion. I mean, it is a small drop in the ocean, that's for sure. But I think that, as Mark said as well, that this is on a different spectrum of ESG investing and of sustainable investing. It's really about investments seeking to deliver that impact delta. So it's the type of investing that is not just about sort of aligning with some societal outcomes, but actually the investment activity is intended to contribute to some societal outcomes. And nowadays it's defined often in terms of SDGs. There's great guidance also from the IFC in terms of how do you make sustainable development goals investable. But many challenges around measuring and then also managing that impact remain, and those are the key challenges in terms of scaling this market with integrity and in a way that continues our fiduciary duty to our investors in terms of if we are going to launch impact strategies.
Right. Before I do the Rocky, I'd like to quickly ask Mark, though, are you dealing mostly, at UBS, are you mostly dealing with impact or ESG? I mean, how easy to even define what is what these days? Because the words are often tossed around interchangeably.
Absolutely. And so one of the key things that we always come here during this week and the spring meetings are to work with groups like the IIF on codifying what the terms are. And that is a huge role that the IIF is playing in the future of finance. So I think we do separate impact investing from the broader sustainable investing subject. We consider impact investing has to have measurable and defined goals to further society in some way. So you have to be able to measure it, whereas sustainable investing can have a broader definition.
Right. Yes, because you've been looking a lot at the issues of measurement, haven't you, and taxonomies recently inside Goldman Sachs.
Yeah, so the way I kind of think about ESG versus impact, and there's also sustainability, responsible investing, lots of different terminology on this. But ESG is very much about fundamental analysis in that it's an input to looking at environmental factors, social community aspects, whether it's consumer acts, etc. And it's input to what you would typically have done in the context of looking at a company and looking at its industry positioning, its financials, right? And it's another set of factors that you pull into as part of your analysis in terms of risk return. So it's an input. Impact to us is more of an output, right? So you want to be more deliberate in terms of thinking about not only the financial returns, but how are you actually having a positive impact on an environmental or social issue, whether it's in healthcare access, whether it's clean energy, and therefore mitigating emissions reduction. And when you kind of look at the broader secular drivers behind some of these things, whether it's ESG, as well as in the context of impact, I think a lot of it was already discussed. They're very secular trends, certainly consumer preferences that are changing. The millennial and the younger generation who's going to inherit a lot of this wealth, who actually care about this agenda, not just from a financial return perspective, but from an impact perspective as well. And then you look at where the policy drivers and regulatory drivers are headed, in part because the impacts are the negative impacts are being felt, whether it's climate change, more and more social inequity issues that we have to address, right? When you look at all of these trends, these are very secular drivers that actually make ESG, as well as impact, very critical as a investment thesis to be able to do and doing well and doing good increasingly. And we see this across all of our businesses in terms of the business thesis becoming a lot more clear-cut.
Right. And yet the complaint I hear from a lot of people is that there's an awful lot of label confusion, fragmentation, opacity, all of these problems. I mean, how is State Street coping with that?
Yeah, so I think if we step back, we all have to acknowledge we have an infrastructure problem. And what I mean by that is ESG is understood, but it's relatively new as a risk that has emerged in the last 10 years. And if you think about our current reporting systems and how we are looking at data, etc., when was the last time we updated our reporting systems? The banks did it after the financial crisis, right? And so do we have, what I find interesting is what's the difference between an ESG product and a non-ESG product? It's that we are acting upon ESG data. And where are we getting this data from? I know where we get the financial data from Bloomberg Terminal, straight from the companies. We're not getting ESG data straight from the companies, or we are, but good data, we define it as being financially material, consistently reported, and comparable. We're not getting that kind of data because the infrastructure on what the floor, what is considered financially material by sectors, are not defined. And so companies, and this is a fast-changing space. So when we engage with companies tell us, we're happy to do what you want, but every investor has a different definition, right? And so there's this infrastructure problem that exists today. And what, as an index investor, we felt that we needed to make change. And talking about impact, and I like the way you defined it as an output and not an input, but we stepped back and said, look, we need to be part of this team. We're the third largest asset manager in the world. We can make a difference. And what we did was to take multiple data providers, because when we look at data of ESG data, the scores of one company don't correlate, right? There's a wide dispersion on. And so if there's low correlation between the scores, what we did is we took multiple data providers, and show of hands, how many people here have heard of SASB, Sustainable Accounting Standards Board? Yeah.
It's quite a self-selecting audience, I think.
So SASB is trying to do what FASB did for accounting standards is doing for sustainable accounting standards. And that's setting the floor on materiality. So what we've done is we've actually brought that framework to life by getting multiple data sources and scoring companies. We have about 6,000 companies we score to give an insight on performance. Now, what is interesting, and I'd like to give examples. So let's just say we have an electric car company here in the US, and you look at their, what we call it R factor, that's responsibility factor, the score. And we looked at their R factor score, and they are marginally above the peer and global peers. But when you compare them to the domestic, what I would call brown, and I'm putting in quotes, brown car manufacturers, they underperform. because it's about how they manage sustainability internally at companies, right? So here's a green company that from an operational perspective is underperforming. So that's what we need today. We need sustainable capital markets, and sustainable capital markets need data and information.
Well, I often think that the issue of taxonomy about what's green and what's brown, in some ways is wrong. We ought to be talking about olive or different shades of olive, because you have things that are partly green, partly brown, things that were brown and moving towards green. You need to have ways to incentivize companies to go from dark brown or dark olive into a lighter shade of green. This two binary taxonomy doesn't really work. But do any of you use, or do you use SASB or GRI or all the other measurement tools that are out there?
So I've sort of got to admit I'm a little bit biased because I've been doing this for 20 years and I've sort of seen the evolution of these different sets of standards. I want to push back on one. Impact investing is not a new thing. 20 years ago it was called patient capital and slow capital. There have always been investors who are willing to allocate funds and investment opportunities that had additive components beyond performance. We just have a new label that sort of brought attention to this. On the ESG side, if you look back 20 years ago when GRI was just beginning to become widely adopted after its first iteration, you saw this explosion of disclosure on corporate social responsibility data points. The number of companies actually publicly disclosing information jumped from roughly 15% of the S&P 500 to about 45% in about a 3-year span. So you get GRI actually pushing some disclosure. Problem is it was not actionable data. And so you see this group of data points and these companies emerging to aggregate this for us. MSCI, Sustainalytics, the ISS Ethics of the world, to pull this data together. But it's all non-standardized, non-consistent, largely lacking a time series disclosure. SASB pushes a structure to it, but its material and relevant data is what's governed by SASB. And there are different stripes of ESG investors. As fiduciaries, what SASB is looking for is not ESG as a supplement, it's ESG as a core component of what we are supposed to be evaluating when we're looking at a credit or an investment opportunity. We should be looking at those factors. That additionality, a lot of what would fall under the S in the ESG, where diversity comes into play, where supply chain policies that are non-risk factors are in play, all of those, that's additive for sets of investors. It doesn't address those unless it's material and relevant. So GRI sets a standard. SASB brings it into what we're supposed to look at as fiduciaries, but there's still a demand for investors for more than that. Impact investing was one part of that, but there are other elements to that.
Well, we had a piece in our Moral Money newsletter just last week looking, with a report from a law firm, looking at adoption rates of SASB versus GRI and others. And the reality is that SASB hasn't really made a lot of headway in terms of take-up. Do you look at SASB and things? Or?
So we look at SASB. In fact, I sit on the SASB Investor Advisory Group. I should disclose that. But I think there is a new dimension to SASB that it brings to the market, which is that it really focuses on financially material, environmental, social, and governance factors. And that's actually the defining characteristic of the market now, right, is that ESG is thought of as information that really has a bearing on your investment case. And for instance, for us, we've had ESG integrated equity strategies for over 10 years now, going from thematic to looking at in a kind of bottom-up fundamental process of how this information interacts with the top line or the bottom line of the business, right? So in terms of downside risk protection, or in terms of a medium 3 to 5 year range in terms of the revenue generation ability, the kind of factor on the fade rate within our investment cases. So what's important about SASB and about the current environment is that there's a realization within the investment community that not all ESG factors are relevant for your investment. And I think we should be transparent about that. And then if we go a little bit level deeper than just sort of the aggregate level of ratings, it's hard to price climate risk, right? How do you break that down? It's clear that it's not priced in the market in many investment cases. We joined a UNEP FI carbon delta pilot to try and look at how the different regulatory changes and these national disclosure plans, nationally determined contributions toward the Paris Agreement, the policy environment will likely impact sectors within different jurisdictions. We looked at what types of assets will be difficult to liquidate within that type of environment when those regulations come into market. And we're trying to also have a different way and a scenario analysis for physical climate risk. So it's challenging to price this, but where SASB is very helpful and where the current kind of research in this is, given the new ESG data sets and also what wouldn't seem necessarily as ESG data, but let's say geolocational data, we can actually use modern data science and a detailed analysis to bring that into our kind of financial analysis and into the investment cases. And that's where we need to be today.
Right. I'm thrilled to see that the accounting issues are generating enough passion that you all want to speak at this point. That's fantastic. Haraki and then and Goldman Sachs.
Say, we shouldn't forget, SASB got codified just last year. It's been less than a year. And in less than a year, we've seen, and these are SASB numbers, 150% uptick in the companies reporting. Now, it's a small base, I agree. But in 1 year, they've had adoption rates. If you couple that with what we are doing on the stewardship side, we are pushing with companies and engaging, and we're using it completely in our stewardship program. And we've already had 100 companies reach out to us since September for their R factor scores. And when we send them the scores, we send them a map as to how they can improve. On the other side, Bloomberg has chosen the R factor to set up SASB Bloomberg indices, both in fixed income and equity indices. So you have money going to be run against it. That is very powerful.
I used to say when I was covering credit derivatives 15 years ago that I couldn't imagine a sector more plagued by alphabet soup than securitization. I think I've now discovered one in terms of all these new bodies and products and things. But anyone else want to comment on this accounting issue before I turn to...
Sorry.
Yeah. Please all jump in. It's inspiring passion.
No, I was just going to say, look, we actually did our sustainability report and mapped it against SASB because we actually think that that is a material framework and investors are actually asking for it. And we obviously are, as a public company, engage with our investors in addition to acting as a investor ourselves. The other point that I would add is, having said all that, and data set is absolutely critical as a foundation for obviously understanding how to think about risk and return. But to me, it provides a starting base. It's really not the end base, exactly to your point. It's about taking that data, understanding what are the right questions to ask because you're competed against historical data as well as against its industry and geography, and really then starting to engage or asking the hard work. And it depends on the strategy, of course, whether you're passive, active, equity, debt, it varies slightly. But I think that's an important point to note. And the other thing which I think is absolutely critical to know is that we actually have a product called GS Sustain that's been doing ESG integration as part of fundamental research analysis for now over 12 years. And one of the things that we find is that when you actually have measurable performance targets, so it's forward-leaning and it's actually quantified and not just qualitative data, because oftentimes data can be in the form of qualitative data, that actually has a stronger linkage to some of the momentum and value.
Interesting.
And so looking forward, I think, is also an important part of this, not just looking backwards, and oftentimes disclosure tends to be backward-looking.
Right, interesting. But I was going to say, if anyone wants to ask any questions from the audience, and if you can work out how to use the app, please do send it over. But I might also go terribly 20th century and analog and ask for anyone who wants to wave their hands and ask a question too, if I'm allowed to do that, just looking at the organisers. So don't be shy about asking questions if you want to raise a question. Can I just quickly ask, though, I'd like to ask you, Mark, do you ever worry that all of this explosion in interest on the part of consumers is just a bull market fad? And that when markets crash and the global economy slows down, and when all those millennials, those uppity millennials actually grow up, they will just forget about all this?
I don't think that's the case. And I think, but I'm mindful of the difference, that you saw in the last panel here, because I just drove up from Central Virginia, beautiful fall. Climate change, if you look forward, you said, well, it was really hot a week ago or something like that. You might find it, but it's just so removed from people's lives there. Whereas you can go to, I live in Switzerland, you go to the Alps and the kids say, in that picture, the glacier was here and now it's there. And, and then you go to Asia and you have a totally different experience with air quality and things. So I think that, it's hard in the United States. We've surveyed our clients from around the world. 60%, 58% of our clients believe that within 10 years, sustainable investing will be the norm, but that score is much lower in the US and the UK. So I don't think it's a fad. And as you know, any crash or other thing that happens in financial markets tends to lead to a lot more regulation, not less regulation.
Interesting. Does State Street or Goldman Sachs have a view? Because you're both, in terms of the difference between the American investor base and elsewhere. Do you think it's a fad?
Absolutely not. So I've been in the field for about 20 years, seen 3 crashes. Every time there's a crash, governance matters, ESG matters, right? That's when people start really trying to understand what's going on. And I think even if there's a crash, it's just going to get more. And the reality is, it's what people, there's a lot of education. So when it's going to happen, and that turning point is hard to predict, but it's really stemming from, even like you said, Texas is there, right, making interesting statements.
Yes.
That's
partly because they've suffered from hurricanes recently.
Yeah.
As you say, once you've actually experienced the actual, reality of this, then it begins to matter more. But
to me, if you really think about the core of what we're talking about, it's about sustainability, right? Sustainability is about sustainability of a company's performance in the long term. And through those ups and downs, those companies should be more resilient if you're doing, again, the hard work around the ESG analysis and understanding what does make a company more sustainable, as well as outperform in the long term, and also from an investment thesis. And just to share some anecdotes, and again, these are sort of early markets, so I don't want to over mainstream everything that we're seeing. But green bonds is an interesting example where there's been a lot of debate around, do we have a green premium? And also, what does it look like when you have volatility in the fixed income markets? Do they actually outperform? And you are starting to see some signs of that green premium, as well as when there's been volatility in the markets, they actually tend to do better from a resiliency perspective. Now, is that driven by the fundamentals of the company and the credit quality? One could question. It may be more driven by the fact that the actual investor base tends to be sticky and there's a lot of demand for these assets. But a really interesting new evolution in the fixed income market, and I think this is sort of where the direction of travel is and why I think this is not a fad, it's actually a secular trend, is we actually had the opportunity to work with a company called NL, where they did a number of green bonds, and they said, look, our entire strategy is now sustainable. We have a net zero emissions long-term goal that is pretty much climate aligned. And we're actually executing on this, where we are investing the bulk of our capex into renewable energy, digital infrastructure, and in the process, de-risking our financial performance, increasing growth and capturing greater margin, and therefore outperforming. Right? And so they said, I'm not going to ring fence my use of proceeds anymore. I'm just going to do a general corporate purpose SDG-aligned green bond, SDG-aligned bond, but specifically put teeth and showed that I'm actually serious about this. I have a sustainability metrics that was a renewable energy target. If I miss that, I'm actually going to pay more coupon to the investors. The ESG investor base embraced this, and it was significantly oversubscribed, and they saw a tangible cost of capital benefit when we did this in September. It went from 1 to 1.5 billion oversubscription, and we also worked with them at 2.5 billion euro SDG-linked bond in the European market recently, and that also saw oversubscription and the cost of capital benefit. So these are great examples of how you actually mainstream these things and actually think through the risk-return profile of a company and ultimately link it in a way that actually makes sense from a cost of capital perspective. And I think this is the direction of travel.
Are you expecting to see lots more NL style bonds? Because we know that from our own readers that NL has caused an extraordinary buzz.
I would agree with this, is that I think in the Nordic region, for instance, corporate issuers, when considering sort of their capital market activity, they are considering green bond issue as a real option of raising capital, not only for those green projects, but also for the business as a whole. So the market is becoming more liquid, there's more activity, that's fantastic. And I think that that sort of speaks to the fixed income universe and fixed income investors in general driving this long-term global capital allocation. And it's one of the reasons, in fact, why sustainable investing won't go away, because they are looking at their durations and they are looking at, in relative value strategies, the sectors in terms of how prepared they are to mitigate climate change and protect downside risk. So I think that actually the fixed income market is really important, and that's been one of the reasons for us why, for instance, within emerging market debt, we've started to look at this, and I actually see our portfolio manager on emerging market debt here. So I think it's really the fact that the fixed income universe is starting to pick up on this. It's a signal for how sustainable investment is here to stay.
And then we got a couple of questions coming in as well.
So this highlights one of the data challenges here, right? So when we're talking about SASB and we're talking about GRI and we're talking about existing ESG data sets, they're largely focused on corporate disclosure. And that has some utility whenever you start looking at corporate bonds. But the reality of the fixed income universe is that the fixed income investors are looking at different factors than an equity investor will. And this comes into play here in the United States. The U.S. municipal bond market has zero codified ESG coverage. None of the big three provide any data. So anybody who's doing ESG and munis is creating their own data set, their own ratings. So we're still lagging in that sector of the market. You move over into a place like bank loans, into some of the alt categories, the available ESG data is minimal.
Yeah.
This back just for a moment, though, coming back to SASB, one of the side benefits of SASB as a standard is whenever I get the opportunity to talk with analysts in different asset classes within the organization, because SASB uses terms that they can relate to in a structure. The conversation is about ESG or values. It's about financial materiality of these E, S, or G factors in my sector or in my asset class. It makes it a lot easier conversation than I've ever had in the past 20 years. So.
Right. Well, we're getting questions already coming through, and one of the questions which comes in nicely is, what about passive investment vehicles? We sadly don't have any. Well, yes. Would you consider yourself representing the entire passive sector today? Maybe I can direct it to you. Is it time for passive to get more involved in this? Is it possible for passive to get more involved? Is a whole waste of time if it ends up being purely about active investing?
Our largest book of business is index investing, so passive book of business, both from a fixed income and equity perspective. And the answer is we are involved. You know, our involvement is very different. We are looking at a structural change, right? So we are looking to help build sustainable capital markets. We are large, we understand that, we have the entire index, and by actually holding companies to a particular standard and requiring some disclosure and rewarding them for it from an investment perspective, we're actually incentivizing behavior change.
So you're representing both the passive and the active side of State Street?
Yeah.
Okay, that's because I say most people until now have assumed that it was really an active game. So
the indices that were just launched at Bloomberg, that's important to us. Our entire index business, we have smart beta strategies that use our factor, and so we do a lot of incorporation, and that's what people. That's where the impact story is very interesting. You know, impact as defined currently is very narrow, but the reality is the investor who's embracing ESG, if you look at it from an output perspective, wants to make sure their money is making a difference. And at this point, from an index perspective, the impact they can have by investing is by helping create that infrastructure, because we are solving for that infrastructure problem that exists. Because from an index perspective, unless you don't solve for that infrastructure problem, you're not moving that capital markets to become more sustainable.
Right.
I'd say something on this, because our platform for sustainable investment is kind of agnostic to passive or active, because if you think about for private clients in particular, but ultimately, all investors, the biggest amount of investment performance comes from their asset allocation, not the specific investments they choose in each of those asset buckets. And so, we've set up 100% sustainable asset allocation, and whether one sleeve of that is active or passive is far less important to us and far less important to the investor ultimately. So I think they can both coexist and both contribute to a more sustainable agenda.
Right, right. Well, we have another question, which is this. Since millennials were so hard hit by the 2007 crisis and the ensuing monetary policies pushing asset valuations upwards, to what extent do you agree that millennial appetite for impact investing is all the more remarkable?
Well, that really assumes that the question assumes that this interest would be for an asset class that would underperform traditional investments, I think, and most of us probably don't think that's the case. So, you could say, why are millennials so much smarter in identifying the better investments of the future?
Are there any millennials in the room? I suspect there aren't that many actually looking at the demographic right now, but there we go. Find a millennial and ask. You're a millennial?
No,
Right.
I'm not.
Okay.
But
I think Mario is
Gen X.
millennial, yes.
Well, I am a
Older-
Gen
older
Xer,
millennial.
and I do know that at that same time frame in my life and my colleagues' life, there was an interest in doing good also. The challenge was there were no products available. Part of that comes back to the ESG data. We did not have the option. I think the millennials have this opportunity where they're maturing in a world where there's available products, there's available data, and there's available technology that allows them to access those, whereas previous generations did not have that. This is not, this sort of interest is not new to a generation. It has been an unsatisfied latent demand for multiple generations.
Right.
And it may be helpful, perhaps, just to give a few examples of the range of strategies on both passive and active, and also talk about why you actually can do well and do good, because again, oftentimes people take a very narrow perspective to some of these things, and what we are seeing right now is, certainly on the passive side, you're talking about smart beta and tilting, where you can actually, for example, reduce carbon emissions and be able to still track the market, benchmark and minimize market tracking errors. So that's a very big strategy as an example in the passive space. And then you overlay engagement on top of that to try to affect change and move the companies as an investor as well. And then you also have active strategies where we're seeing hedge funds now jump into the foray, where they're trying to really proactively partner with management teams and again capture the actual alpha that comes from it by moving them quicker to become more sustainable. So it's very much about capturing that and minimizing the risk in the case of some of the passive strategies. And then in the private strategy, we're seeing a whole range of economically beneficial outcomes to invest in. So we've been a long-term investor in clean energy. And again, the economic thesis around clean energy is such that it's become way more compelling to invest in clean energy than in conventional energy resources. And finding that sweet spot, I think, is important because now utility scale renewable energy, in some ways, there's so many actors coming in and capital flow that the return from an investor perspective has become more compressed. But we found an area where there's a need for capital and where you can actually make returns, and that's in commercial industrial space in the US. And so we actually raised a $2 billion fund to invest in that, and that's actually very much driven again by the economic case, in addition to trying to scale clean energy and capital. So there's plenty of examples around the different strategies where you can actually make returns and have a beneficial outcome in environment and social issues.
Right.
I'd like to add to this from the older millennial point of view, if I may, which is that that I think that the new generation is right in thinking that if 80% of value within S&P 500 is an intangible or kind of non-financially regularly reported factors, then investors need to do better. So that's part of the smartness of going into ESG integrated or impact or other strategies that use the available information better in, say, active management strategies, and then you try and use data science and new ways of analyzing data to build these factors into the context of other financial factors, which is within the passive context. Not easy for many reasons, one of them being that the data sets in ESG don't date beyond an economic cycle, right? So for us to actually have reliable time series to backtest things like ESG factors, not the most straightforward thing. Carbon pricing, a hard thing to do, and so on and so forth. So I think that there's a long way to go, but to the point that my colleague was making around the sort of economics being there and then the consumer sentiment being there. I mean, for the first time, the levelized cost of renewable energy is at par with conventional sources of energy in certain markets. You have unit costs of certain sustainable products and services, not only in the Nordic markets and Nordic corporates declining, and you have that sort of consumer and industrial sentiment moving where you start to see these tipping points, not necessarily within this quarter or the next quarter, and that's why companies still are conscious and corporates are conscious about how they manage their capex to actually arrive at these tipping points. But on a 3 to 5 year investment horizon, we see many of them out there. So this is a really exciting market to make the most of this information, and it's also a challenging market. But the millennials are right to insist on it.
Right. I'm curious, how do you measure or calculate, just looking at one of the questions here, about measure or calculate the impact of the environment on the market? I mean, are you hiring climate change scientists? Are you doing what AllianceBernstein recently did and decided to do and send all of its portfolio managers to climate change school at Columbia? I mean, how are you actually teaching people about this? Because I'm told by a number of asset managers and company boards that they'd like to get climate change people or expertise on board, but there's quite a scramble and there's a bit of a talent issue here. So I'm just curious, how do you actually address this in practical terms?
I think it's a great question because it gets to the scalability of impact. And so, this company that did the bond deal with different returns, that to measure that is doing it by company basis is probably not so scalable. So, and also we don't, as a very large wealth manager, we don't want to necessarily put that risk of identifying the quality of the impact assessment on our balance sheet. So finding outside expert firms or partners that are willing to engage with recognized expert groups, I think is the way that I'd like to see the industry go, because I think it's the most scalable and and also will move us towards creating global standards for impact.
Right.
I would say that education is a very important part of the conversation we have with clients. So often we do have programs that will have a climate scientist, and then we'll talk about financial, how do you address that in your portfolio? So that's one aspect. I think another aspect of this conversation is actually giving them some kind of reporting, client reporting, improving client reporting to give them insight into what their current portfolio looks like, right? So giving them the profile of the emissions, and especially if you're holding the benchmark, you really want to understand, or the entire index, you want to understand what your profile is. So actually, that's at nascent. I would say everybody's trying to work at improving reporting, but that's where some of the education will start coming from, because when you start giving clients insights into their own portfolio, that's when they start caring. They're like, what, I had this? I didn't know that, right?
Right, interesting. And what about another question down here is sustainability in a wider sense? What about the sense of community and the S part of the ESG? Is that measurable? Do you think there's enough data out there to actually look at that?
I'd come in on actually both really briefly. That we this Unipify climate change financial modeling pilot called Carbon Delta, and the results are now available online, and you can actually upload even your portfolios to see your climate risk exposure according to the policy risk, the transition risk, and the carbon risk. And that was an effort to join because climate change is a big thing. How do you bring that down to a way of looking at pricing and really looking at the financial implications? So I would encourage people to take a look there in terms of what type of value at risk scenario analyses were built. But then on this S, I think the key part is to sort of break the E, S, and G down and understand for your investment activity what are the relevant S factors. So when it comes to our investment activity, and based on, of course, SASB and other materiality factors that are industry specific, but then also what we've learned through our engagement practice, we've had a focus on sort of data privacy, data security aspects, but also on employment and sort of labor force factors. And it is clear if you look at when we look at our say global equity portfolios and we are analyzing the ESG risk exposure of a given position, let's say a global technology company when the GDPR came into market. That there were many positions where the ESG or the S factors, so the ability to manage the data privacy or the cybersecurity or the data security risk was not priced in the position. So markets in early 2018 were bidding up a number of these technology stocks, and then for certain incidents, say the Cambridge Analytica scandal happened, you see that the stock price depreciates significantly. So it is clear that it's not priced in, so the onus is upon investors to try and get more granular into how the operations or the business model of a given position are exposed to this risk.
Yeah, I must say, I mean, because certainly, most journalists are trained to think that a lot of the S factors are a bit hippy-dippy and irrelevant, and then you look at what's happened, not just with the tech sector and the privacy scandals, the hashtag #MeToo issues. I mean, there's a number of reputational risk management issues right now, which I think the C-suite and the investment world is just waking up to with a vengeance.
So I'll just say that, we looked at SASB because SASB gets a rap saying they're not very good at S. And we agree that human capital management is the next challenge for us to conquer from an ESG perspective. Having said that, whether it is labor practices or supply chain risk or labor in your or S factors in your supply chain risk or diversity, SASB does have a framework which looks at S, and it'll improve over time. I think at this point, many of the reputational risk issues get captured in controversy scores. So that's one way of where that starts showing up for companies. And then I think the broader question, and going back to my infrastructure comment that we have an infrastructure problem, going back to the statement, look at how our accounting systems are currently built, right? So I was talking to a CFO, and he said, if I actually were to refurbish a building, I could capitalize that and write it off over time. If I were to retrain my team, right, I could not do that. It's an expense. So we have to think about this at a system-wide level where we start thinking of humans as capital, and what does that mean from an accounting perspective to start with, because that is a large part of our balance sheet that is it's missing on our balance. These are intangibles.
Well, I must say, I just realized we're actually out of time. It's 10 o'clock and we're due to go to 10 o'clock. But it's been such a fascinating debate that I've almost lost track of time. I take away a number of points as a journalist, and I'm the journalist who's paid to be cynical. So I spent much of my life going, oh, ESG. I often joke to my colleagues, for most people who aren't in the industry, ESG stands for eye roll, sneer, and groan. It's like, comes above. The points I make, though, are one, I am very struck listening to your conversation, not by the seriousness of the debate now, and if you like, almost the maturity of the industry, but the fact you really are grappling with a number of different strategies, tools. You're keenly aware of the challenges, and the challenges are significant around accounting standards, transparency, scalability, et cetera, but there really is a plethora of activity going on right now. But I'm also very struck by the point that you made about education, because in some ways we're here in the room as a self-selected group. People mostly are here to get geeky because they're passionate about it. The wider world is very much playing catch up, whether that's in terms of politicians or investors or regulators sometimes as well. One thing I'd leave you with, which I find very interesting, is that we at Moral Money, the platform we cover this, surveyed our readers to ask why they were reading us and what they thought about the platform. And it turned out we were absolutely astonished to discover that 80% of the people who replied to the survey, so a self-selecting group, but still a big group, I mean, the fact that we had record high numbers of people even filling out the wretched survey, 80% of them said that they thought ESG today is very or extremely relevant to their jobs. These were primarily middle manager people, and that's how they chose to self-identify, but only 18% consider themselves to be experts. And to my mind, that is why groups like the IIF are engaged in this massive work stream, why there is this interest and debate, but also why there is a big challenge. And if the challenge is not resolved, there's a danger of mis-selling scandals, or disappointment, or all kinds of problems. But if it is essentially addressed, we could be at the beginning of a very, very interesting phase in finance. So best of luck to all of you in figuring it out. Thank you.
Thank you.